So, video number 49. So, this is part number 49 of the positional trading video series that I started long ago. A lot of my YouTube subscribers have commented regarding the consistency with which I have been publishing these videos. Thank you so much for the comments. And yes, creating this video series has uh, improved my discipline and consistency. So, as I teach this to you, I also become very good at applying this strategy in the market. Right. So, they say learn to teach and teach to learn. I had an old friend, a very wise man. He always used to say, learn to teach and teach to learn. So, it's been a fantastic video series. We are coming towards the end of this video series. And I bring to you another weekly time frame chart. However, in this chart, I want to show you some elements of VCP, which Mark Minervini discusses in his book, Trade Like a Stock Market Wizard or Think and Trade Like a Champion. If you read those two books carefully, occasionally you will find weekly charts as well there. And the VCP is shown on the weekly chart as well. So this is the chart of GRSC. This is a weekly time frame chart. So as you can see, VCP characteristics here. So I will draw the VCP for you. Remember the 10 candles, 4 points, and the blue, green, red. That concept is only applicable on the daily time frame chart. The 10 candle concept is not applicable on the weekly time frame chart. Why is that so? Because on a weekly time frame chart, if you look at 10 candles, then you will have to wait for 10 weeks for the base to complete. Whereas on the weekly time frame chart, even 3 bars are more than enough. So 3 down bars after a particular bar, okay, that should be more than enough for us to identify that as a base. You might hear some background noise. I don't know whether the microphone is capturing the background noise or not. But next to where I stay, there is some construction work going on. So in case if you hear that background noise, I am sorry for that, but the video will not stop. Okay, let's continue. So let's look at the VCP. So this is where the base starts. 0.1, 0.2. This is 0.3, 0.4, 0.5, 0.6, 0.7. Okay. Same concept which I apply in the daily time frame chart. You go from highest to lowest to highest to lowest to highest to lowest and so on. Okay, so basically point number 5 should be lower than point number 3 and point number 3 should be lower than point number 1. Point number 4 should be higher than point number 2 and point number 6 should be higher than point number 4. Okay, that's how you draw it. And in the description of this video, you will see how to draw the color shaded base, how to mark points inside the base. All of those links I have placed in the description of this video. You can check it later. So you see a nice VCP here with 7 points inside the base. Point number 6, by the way, that becomes your actual buy point. However, if you notice, Market Smith chart, they will mark this as the pivot point. So they will say that this is a consolidation pattern and the high of this, which is 556.80, that becomes your pivot point. But if I were to look at this base, I would consider the high of this candle as the actual pivot point. So for this video, we will take this high as the actual pivot point. Okay. Don't apply this VCP method on the weekly chart again and again. 99% of the time, please stick to what Market Smith is giving you. So if they are saying that the high of this bar, if they are saying that the high of this bar is the pivot point, then take the high of that bar as the pivot point. This is like the advanced way of buying the stock. You are buying it inside the base, so it is slightly risky. So what I will do is in this video, let's go with what MarketSmith is saying. They are saying that this is base number 2. They are saying that this is a consolidation pattern, and they are saying that the high of this uh, bar is your pivot range. Okay, is your pivot point. So let's stick to what they are saying, and let's also observe whether the VCP is working or not. Okay, so let's draw the pivot range as usual. Before we draw the pivot range, let's count the number of red bars inside the base. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Out of 14, how many are high volume? So this is high volume. Yes, this is high volume. Yes, high volume means close above the blue line. So out of 14 red bars, there are 2 red bars which are high volume. The remaining 12 are low volume. So uh, it is in our favor. Okay, number one. Number two, it is base number 2. So it is early stage. Number 3, the relative strength of this stock was 82 at this time. Number 4, if you look at the daily time frame, 12th of June 2023, if you look at the daily time frame, so 12th of June 2023, you have the blue, the green, and the red. Even 9th of June, the blue line has already crossed the green line. So you have the blue, green, red on the daily time frame chart. So that's number 4. Number 5, look at the tight closings here. Okay, from here till here, these are tight weekly closings. Here also you see tight weekly closing. Here also you see tight weekly closing. Here also you see tight weekly closing. Okay, so the base is early stage base, high relative strength, the red bars in our favor, tight weekly closings, tight spreads, weekly VCP, clearly marked pattern, clearly marked pivot range, and you have a VCP kind of a characteristic inside this base and a nice prior uptrend before the base formation. Okay, all of these points, please make a list of what I have said in this video. Uh, Use that list to identify high quality bases in the future. Okay, so let's draw the pivot range. So the high is 556.80. I do this in every video so that you get used to this. So blue color, so 556.80. Then let me take out my old school calculator. I take my old school calculator, 556.80 multiplied by 1.05, 584. So 584, that's the pivot range. Okay, very, very simple. Price is between the pivot point and the blue line. Very, very simple. Then you will draw the selling range. So what was this 556.80? 556.80 multiplied by 1.20, which is 668. 668. Then 556.80 multiplied by 1.25, 696. So this will be green color. Okay, selling range is established. Stop loss range, red color. Five five six point 80 multiplied by 0.92, which is 512. So I will write here 512, and 556.80 multiplied by 1, sorry, 556.80 multiplied by 0.95, 528. That's it, selling range. As you can see, the price is below the stop loss range. So red color is the stop loss range, blue color is the pivot range, buying range, and the green color is the selling range or the target range. The price is below the Stop loss range, that is not a problem. As long as the price is between the pivot point and the blue line, which is the 10-week simple moving average, we don't have a problem, right? And keep an eye on this high as well. So let me mark a line there, which is high of that candle is 529.80. So let's do that, 529.80. Okay, that is the high of this bar. Correct, 529.80. So it looks slightly, I'll keep it like this. Okay. See, the high of this bar is 529.80. And if I mention here 529.80, it looks like the bar has gone above the line, but that's only because of the thickness of the bar. Okay. But let's look at the breakout. So what are we expecting here? Let me remove this line to avoid confusion. So what are we expecting? What's the volume? 2.68 million. So 2.68 divided by 5, 0.536. So 536,000 shares is what we expect to be traded on Monday. So let's see what happens. See, Monday, how many shares traded? 8 million. How many were we expecting? 536,000 shares to be traded. That is what we were expecting. So let us say, depending on the position size you want to take, let's say you want to buy 100 shares. So here you will end up buying probably 50 shares when the stock enters that pivot range. You would buy 50 shares plus you would see extraordinary volume coming in, and the stock very much was closing in towards the upper line of the blue zone, right? So you probably got a chance to buy another 30 shares. So out of 100 shares that you plan to buy, I think you were able to buy 80 shares out of 100 that you planned to buy because of extraordinary volume coming on Monday. On Monday itself, the price has shot up and gone above the average weekly volume. You still have Tuesday, Wednesday, Thursday, Friday to go. So you can only imagine how far this stock can go uh, during that week, because you still have 4 days to go and the volume has already exceeded more than twice the average weekly volume. Okay. Just because volume is going up doesn't mean that the price would go up. So let's look at Tuesday. Again, Tuesday, the closing was inside the blue zone. Okay. You probably did not buy the remaining 20 shares because the price went down. Wednesday, Thursday, Friday. Okay. Friday it finally closed up, so you got the chance to buy the remaining 20. By now you understand what I'm talking about here. So whether you take this as the pivot point or this as the pivot point does not matter. This was a clearly a high volume breakout and you got an opportunity to take a nice position size, let's say 10 to 15%. Let's assume you took 15% position size on this stock. Okay. Extraordinary high volume, 4 times the average weekly volume. That's a nice breakout. Moreover, the price has closed above the pivot point, not just above the pivot point, but also above the pivot range. Okay. Fantastic. Of course, what is our trade management plan? As usual, we'll sell 1/3 here. We'll sell another 1/3 when it closes below the blue line. We'll sell another 1/3 when it again closes below the blue line. And in any time, if the stock closes below the blue line on high volume, we will take a complete exit. Okay. So we will sell 3 times. Moreover, when we sell for the first time here, we will move our stop loss to break even on the remaining shares to neutralize the trade, to make that trade risk free. Before I continue to move the price forward, let us again go back and look at what are the qualities of this base. Number one, early stage base. Number two, high relative strength. Relative strength was 82 before the breakout. Number three, the red bars, low volume, 12 out of 14 are low volume, they are in our favor. Number four, tight closing. Number five, tight spreads. Number six, clearly marked pattern. Number seven, VCP like characteristics. Number eight, clearly marked pivot range, uh, selling range, stop loss range. Okay. And number nine, a nice prior uptrend before the base formation. Number 10, it's a long base. Okay, having a long base on a weekly time frame chart is also an advantage. Okay, so these are the things that I see on the chart. So I don't use any computer computer automation or things like that. I visually look at the chart and I get a feel of the chart, and I look at market smith data. I shortlist, I filter, I select the stocks, I do liquidity, comparative, technical, fundamental, and market analysis. I try to determine the quality of the base just by looking at the chart, not doing too many automations or calculations. And then I decide the position size. After deciding the position size, I execute the trade on extraordinary high volume. Then I come up with a trade management plan. Once the trade is executed with a proper stop loss placement, I come up with a trade management plan, which is to sell one third, one third, one third. And when I sell the first one third, I will move my stop loss to break even. So that's the whole process. It starts from filtering, shortlisting, stock selection using liquidity, comparative, technical, fundamental, market analysis to decide the position size, then executing the trade on a high volume breakout, keeping a stop loss once you buy the shares, having a trade management plan and executing the trade management plan. Very, very simple. Just rewind the previous 1 or 2 minutes, whatever I said. That's the entire trading strategy that I have given you in just 1 or 2 minutes. Just rewind it and listen to this again. That's all you have to do. You don't have to do anything else. This is not rocket science. Okay. So I have told you what are the factors that are in our favor. So let's move the price forward now. Let's see what happens. See, the stock comes down but never closes below the pivot. Remember what William O'Neill wrote in his book. True winners don't close below the pivot point. Correct buy point. So here it came down, but it never closed below the pivot. Okay. The price is still inside the blue zone. Okay. That's a good sign. Then it continued to remain up and bounced back, continues to remain trade above the. In this case, let us see what is happening. What is the closing price? 582.40. What is the SMA? 579.53, which means the closing price is above the blue line, although it seems like it has closed below the blue line. The thickness of the bar is such that it seems that it has closed below the blue line, but it is not. The closing price is 582 and the moving average is 579. So the closing price is up. So there is no sell sign here. There is no sell sign here. We are still in the trade. And you see what happens here. Extraordinary volume. I think on Monday itself, that volume came. So we have still not sold. We have been sitting on the stock for 2 months because of 8 candles, but the price is above our buying price. So we are not very much concerned. And suddenly Monday, Tuesday, see on Monday, Tuesday. So after 2 months of patience, sheer patience, we finally get an opportunity to sell. And on Tuesday, the rise was so fast. Probably you did not even get a chance to sell in that green zone because the volume came in very rapidly. This is more than twice the average weekly volume, that too on a Tuesday, which means you can imagine how powerful that rise would have been. The stock must have shot up in a very short period of time. So probably you sold somewhere here, or maybe somewhere here because the price rise was so fast. But let's be conservative. Let's assume you sold inside the green zone. The stock must have spent probably half an hour, maybe 1 hour inside the green zone. Safe to assume. For that, we need to look at the daily time frame chart. Okay. We'll not go to the daily time frame chart. We'll just stick to the weekly here. Let's assume, as usual, you book 20% on your first one third, and let's move the price forward. Let's see when does it close below the 10-week simple moving average. What is the closing price here? 798. What is the SMA? 793. So I look here, okay? Look here. What's the closing price? Look here. Closing price 798, moving average 793. No sell signal. What about this? Yes, there is a sell signal. So you have to sell another one third here. So from here, where you bought till here, that's a 34% return. So next one third, you make 34% return. And on this bar, yeah, see on this bar, I think the moving average value is lower. So 812, 810, no problem. So I thought on this bar, the moving average, the slope of the moving average has went down. But if you look at the SMA value here and the SMA value here, the moving average value here, this is 810, this is 812. So the moving average has not sloped down. Okay. Let's look at the next week. Yeah, you can clearly see here the moving average value is 812 and here the moving average value is 807. So that is the slope of the 10-week simple moving average has gone down. So you will book here, you will sell the remaining shares here. It's almost 30% return. Okay. So coming back to our return calculations, very simple. So on 5% multiplied by, on the first position you book 20%, then the next position you booked 35%, another position you book like 30%. Okay. That's 5% multiplied by 50, 85%. Okay. 85%. Yeah. What is 5% of 85? 4.25%. So this is the return that you make on the stock on a portfolio level. So one stock contributes to 4.25% of gain on your portfolio. Imagine getting five stocks like this. Okay, you would end up making like 20, 22% return in that year. Okay. And assuming there are a lot of trades that you take, but those trades nullify each other and these five stocks contribute to majority of your returns, which is this is something that I explained in the risk management video. Assuming you take 52 trades in a week, sorry, in a year, that is one trade on an average per week. And out of 52 trades, on 49 trades, you don't make any money. The trades just nullify themselves. And on the remaining three trades, you end up making good amount of money and they contribute to 80 to 90% of your total return for that year. Okay. Same concept is applicable here. If you get 4 5 stocks like this, multiply that 4% by 5, that's 20% return. So you only need 4 5 good stocks in a year to make a decent return on your portfolio. A decent return is something between 15 to 20%. About 20%, anything about 20% is bonus. You are doing extremely well. Okay. Because 20% is the benchmark set by Warren Buffett. So you understood why you should not sell here, why you should not sell here. Okay. Why you should sell here, why you should sell here. Here you are selling because of the break of the moving average. Here you are selling because of the slope of the moving average. Okay. Here you are not selling because the price is above the pivot range. Sorry, above the pivot point. Here you are not selling because the price is above the moving average. Okay. Here you are selling because you have to neutralize the trade. You have to move your stop loss to break even so that on the remaining shares you don't lose any money. Plus you end up making some money at least in that particular stock. Since you have given the stock 2 months, right? You need to come out with some money at least. What is the point in waiting for 2 months and then giving away all the returns that you made? So you're just wasting time there. So after 2 months of waiting, if you're booking some partial profits, you better ensure that you move your stop loss to break even. Anyways, I am feeling sleepy now. It's afternoon time. The market is about to close. But as usual, we have been discussing old charts here. This is 2023. So, as per the SEBI regulations, we are allowed to discuss old charts, right? I hope this video has been helpful. Uh, VCP characteristics, mainly use it on the weekly time frame, sorry, daily time frame chart. Don't use it on the weekly time frame chart. But as I have shown you here, even on the weekly, it works. Okay. In fact, on a weekly, you get a much better buy point. If you had taken the high of this candle as the buy point, the stock never came close to your pivot point. Here, at least, it was trying to test the pivot point, right? But with VCP, you have to look at a lot of other things like green zone, blue zone, red zone, and things like that. So if you can do that on a weekly time frame chart, that is fine. If you plan to buy stocks in the green zone, but it should set up properly. Like this was 7 points, that too on a weekly chart, 7 points in the base, that too on a weekly chart. And the price is most likely to be in the green zone. So if I remove this, let me, yeah, take this one. Okay. Let's draw the zones. So have a look at this. The price is inside the buy point is inside the green zone, but there are no green zone closings after point 2 inside the base, okay, which we I usually discuss on the daily time frame chart. But that concept is not as much applicable on the weekly time frame chart as much as it is available on the daily time frame chart. Okay, so you see how powerful that breakout was. The very fact that the stock has sustained in the blue zone, trying to test the green zone, that itself is a good sign. But 99% of the time, please stick to what Market Smith is giving you as the buy point. Okay? Don't play around. This is a risky trade. There are no green zone closings, right? After point 2 inside the base. So don't violate the basic principles which I have taught you, and stick to basic trade management rules, principles like the simple trade management principle that I have given you. There are various other ways to manage the trade, but this is the most simplest and the best one I can give you, the most effective one. The 10-week simple moving average is so powerful. It keeps you in the trade for a very, very long time. And it removes subjectivity from the trade. It makes it very, very objective. It gives you a clear signal to sell. Okay. Thank you so much. I will see you in part number 50, which will basically be a last video. I will just do a summary there. Maybe I will show you another chart if I find a good chart to study. But these are charts. Imagine if you study 1000 weekly charts like this. Just go and study 1000 weekly chart basis and see how your skill improves. Every chart, look at the number of red bars inside the base, look at the stage of the base, look at the relative strength of the stock, look at the green bars, look at the volume of the green bars, look at tight closing, look at tight spreads, look at the position of the price with respect to the moving averages, look at the name of the pattern, look at the pivot point, the blue, green, and the red zone. If you do this on 1000 charts, imagine your level of skill. You don't need any automation or things like that. Just by looking at the stock or the chart, you will understand what to do, or you will understand, or you will instinctively know the quality of the base. Thank you so much.